Every systemic financial crisis announces itself through the same mechanism, not dramatic newspaper headlines or obvious market crashes, but through quiet mathematical relationships that reveal when the foundation of a credit creation begins cracking under its own weight. Today, those mathematical relationships cross the threshold that separates normal market stress from early-stage systemic breakdown. U.S. credit spreads have exploded to 12 basis points above historical norms. London credit spreads have hit 18 basis points and show no signs of stabilizing. These numbers represent more than technical market indicators. They represent the early warning system of the global financial architecture, signaling that fundamental credit relationships are approaching breakdown. And when credit relationships break down, everything else follows. Because credit isn't just about borrowing money. Credit is about the mathematical relationships that allow modern economic systems to function. When those relationships destabilize, when risk pricing becomes dysfunctional, when lenders cannot accurately assess creditworthiness, that's not market volatility, that's system paralysis. We're entering the early stages of system paralysis, and the mathematics suggest it's going to get much worse before it gets better. But to understand why today's credit spread explosion represents the beginning of something far more dangerous than routine market stress, we need to understand what credit spreads actually measure and why the current levels indicate problems that cannot be resolved through normal market mechanisms. Credit spreads measure the additional yield that borrowers must pay relative to risk-free government bonds to compensate lenders for default risk. When credit spreads are low, it indicates that lenders believe default risk is minimal and credit flows freely through the system. When credit spreads widen dramatically, it indicates that lenders believe default risk has increased substantially and credit becomes expensive and scarce. But credit spreads measure more than just default risk. They measure liquidity, market confidence, systemic stability, and the overall health of financial intermediation processes that connect savers with borrowers. Normal credit spreads for high-quality corporate borrowers typically range between 100 to 300 basis points over government bonds. During periods of market stress, spreads might widen to 400 to 600 basis points. During financial crisis conditions, spreads can explode to over 1,000 basis points as credit markets essentially freeze. Current spread levels of 1,200 basis points in the U.S. and 1,800 basis points in London represent the transition from market stress to crisis conditions. These levels indicate that credit markets are beginning to price in systemic rather than individual default risk. And systemic default risk pricing means that lenders no longer trust the fundamental mechanisms that support credit creation and economic activity. The immediate trigger for today's credit spread explosion appears to be recognition that the private credit market, which has grown to over $3 trillion globally, faces its first major stress test since inception. And early indicators suggest that stress test is revealing structural problems that threaten the stability of the broader credit system. Private credit enters 2026 facing its most challenging environment since the 2008 financial crisis, with cracks emerging in corporate credit and a series of high-profile leveraged loan defaults in late 2025. The sector has become the primary funding source for AI infrastructure development, with roughly $200 billion in data center debt raised in 2025 alone. But private credit operates with limited transparency, weak investor protections, and unconventional collateral arrangements that work during stable periods but can create contagion during stress periods. When firms begin restricting redemptions to keep capital locked up, that's rarely a good sign. The problem isn't isolated to private credit. U.S. companies issued a collective $2 trillion of public debt in each of the last 2 years, much of it financing AI-related capital spending that has become the biggest single driver of U.S. economic growth, adding over 1% to GDP. When credit spreads blow out simultaneously across multiple markets and jurisdictions, it indicates that the underlying problem isn't specific to individual borrowers or sectors. The underlying problem is systemic loss of confidence in the credit pricing mechanism itself. And loss of confidence in credit pricing creates a self-reinforcing cycle where higher spreads force borrowers to pay higher costs. Higher costs create financial stress. Financial stress increases default risk. Increased default risk justifies even higher spreads, and the cycle accelerates until credit markets freeze entirely. The self-reinforcing dynamic explains why credit spread explosions rarely reverse quickly through normal market mechanisms. Once systemic confidence erodes, it typically requires extraordinary policy intervention to restore credit market functionality. But current credit spread levels suggest we may be approaching conditions where even extraordinary policy intervention cannot restore normal credit market functionality without addressing the underlying mathematical problems that created the crisis. The underlying mathematical problems center on leverage relationships that have expanded beyond sustainable levels, while interest rates have increased beyond levels that make those leverage relationships serviceable. High-yield spreads blew out to 18% over treasuries, delivering a 35% drawdown to high-yield bond investors during the 2008 financial crisis. Current London spreads Approaching 1,800 basis points suggest we're entering similar territory, but the leverage levels underlying today's credit system exceed 2008 levels by substantial margins. Corporate debt-to-equity ratios have increased dramatically. Government debt-to-GDP ratios have expanded beyond historical precedent. Financial system leverage has grown through shadow banking and private credit markets that didn't exist at 2008 scale. When leverage levels exceed 2008 precedent, while credit spreads approach 2008 levels, the mathematical resolution requires either massive deleveraging or massive policy intervention that prevents deleveraging through credit market support. Massive deleveraging creates economic contraction, asset price declines, and further credit spread widening as the real economy adjusts to sustainable leverage levels. Massive policy intervention creates currency debasement, inflation pressure, and eventual loss of policy credibility when mathematical reality overwhelms political intervention capacity. Either resolution path suggests that current credit spread explosion represents the beginning of a much larger adjustment process, rather than temporary market stress that resolves quickly. The evidence suggests we're in the early stages of the deleveraging path rather than the policy intervention path. Because policy intervention requires coordinated global action, while current geopolitical conditions make coordination increasingly difficult. Central banks face competing pressures between supporting credit markets and maintaining currency stability. Governments face competing pressures between fiscal expansion and debt sustainability. International cooperation faces increasing strain as economic nationalism intensifies. When policy coordination becomes difficult while credit markets demand extraordinary intervention, the resolution typically occurs through market mechanisms rather than policy mechanisms. Market mechanisms during credit crises typically involve rapid deleveraging, asset price adjustment, and economic contraction until leverage levels return to mathematically sustainable levels. The speed and magnitude of required adjustment depends on how far leverage levels exceeded sustainability before the credit spread explosion forced recognition of the imbalance. Current evidence suggests leverage levels exceeded sustainability by margins that require adjustment periods measured in years rather than quarters, with adjustment magnitude that affects entire sectors rather than individual companies. The $3 trillion private credit market has become the preferred lender for AI infrastructure. But many of these deals involve off-balance sheet financing, GPU-backed collateral, and complicated leasing structures with borrowers who have never been tested in a downturn. When untested borrowers with unconventional collateral face their first credit stress while owing trillions to lenders who cannot easily liquidate their positions, the resolution process becomes complicated and extended rather than quick and clean. Extended resolution processes during credit crises typically involve multiple waves of recognition, adjustment, and further recognition, as the full scope of leverage imbalances becomes clear over time. Current credit spread explosion represents the first wave of recognition. Subsequent waves typically involve broader recognition of problems that initial analysis underestimated, leading to further spread, widening, and more extensive credit market dysfunction. The pattern typically continues until credit spreads reach levels that eliminate marginal borrowers, force extensive deleveraging, and create conditions where remaining borrowers represent genuinely sustainable credit risks. Is a new financial crisis brewing right under our noses? Today, we are diving deep into some alarming signs that suggest the economy might be on shakier ground than we think. We'll look at credit defaults, corporate stress, and what this could all mean for you. Let's get started. First, let's talk about credit. It's the lifeblood of our economy. But what happens when that blood flow gets clogged? We're starting to see a significant rise in credit default rates, especially in areas like auto loans and credit cards. For example, subprime auto loan defaults have hit levels we haven't seen in nearly 30 years. This isn't just a niche problem, it's a canary in the coal mine. When everyday people struggle to pay back their loans, it signals widespread financial distress. It means that rising interest rates and persistent inflation are finally taking their toll on household budgets. People are having to choose between paying their car loan and buying groceries, and that's a tough spot to be in. This rising tide of defaults puts pressure on the banks and lenders who hold this debt, creating a ripple effect throughout the financial system. Now, let's shift our focus from households to businesses. The corporate world is also showing serious signs of strain. The level of corporate credit stress is flashing red. What does that mean? It means more and more companies are finding it difficult to manage their debt. We're seeing a surge in bankruptcies, not just among small, struggling startups, but also with some well-known established companies. Think about firms in the retail and transportation sectors that have recently filed for Chapter 11. This isn't just about a few poorly managed companies, it's a systemic issue. For years, businesses took advantage of ultra-low interest rates to load up on cheap debt. Now, that party is over. As that debt needs to be refinanced at much higher rates, many companies are facing a wall of maturities they simply can't handle. This leads to layoffs, reduced investment, and a general slowdown in business activity. The S&P Global Report on Corporate Distress shows the highest level since the initial shock of 2020. This is a critical indicator because corporate health is directly tied to the job market and overall economic growth. When companies are struggling, everyone feels it. So we have rising defaults among consumers and growing stress in the corporate sector. What's the next logical step? Economic contraction, or what most of us would call a recession. These two trends are classic precursors to an economic downturn. When consumers cut back on spending because they're buried in debt, and businesses stop hiring and investing because their own finances are precarious, the economy naturally slows down. The big question is no longer if we'll see a contraction, but how severe it will be. Some economists are talking about a soft landing where the Federal Reserve manages to cool inflation without causing a major recession. However, the data we're looking at paints a more concerning picture. The combination of high interest rates designed to fight inflation, coupled with the existing debt burden, creates a potent cocktail for economic trouble. Let's connect the dots here. It's a chain reaction. First, central banks raise interest rates to combat inflation. This makes borrowing more expensive for everyone. For consumers, this means higher mortgage payments, credit card interest, and car loan rates. For corporations, it means the cost of financing their operations and investments goes up. As costs rise, consumers with stretched budgets begin to default on their loans. This puts pressure on financial institutions. Simultaneously, corporations, especially those with a lot of debt, see their profits squeezed. They respond by cutting costs, which often means freezing hiring, laying off employees, and shelving expansion plans. This reduction in corporate activity and consumer spending leads to lower overall economic output, which is the very definition of a recession. We are currently witnessing each of these stages unfold in real time. Let's look at a specific sector, commercial real estate. This is a huge part of the economy, and it's in deep trouble. With the rise of remote work, office buildings across the country are sitting half empty. This means property owners are not collecting enough rent to cover their mortgage payments on these massive buildings. Many of these loans are coming due in the next year or two, and they'll have to be refinanced at today's much higher interest rates. The problem is the value of these buildings has plummeted. So banks are facing a double whammy: borrowers who can't pay and collateral that's worth far less than the loan amount. This is a multi-trillion-dollar problem that could trigger a wave of defaults among regional banks, which are heavily exposed to commercial real estate loans. We saw a preview of this with the bank failures last year. The commercial real estate crisis could be the next major domino to fall. So, what does this all mean for the average person, for you? First, job security could become a concern. As companies tighten their belts, the job market, which has been remarkably strong, could weaken. We might see hiring freezes become more common and layoffs increase. Second, your investments could be impacted. A recession typically means a downturn in the stock market. While it's never wise to panic sell, it's important to be aware of the risks and ensure your portfolio is diversified and aligned with your long-term goals. Third, credit will likely become tighter and more expensive. If you're planning to buy a house or a car, or even get a new credit card, you might find it harder to get approved, and the interest rates will be higher. This is the financial system protecting itself from the rising risk of default. It's not all doom and gloom, though. Being aware of these trends is the first step to preparing for them. What can you do? On a personal level, this is a crucial time to focus on your own financial health. Pay down high-interest debt, like credit card balances, as quickly as possible. Build up your emergency fund. Having 3 to 6 months of living expenses saved in cash can provide a critical buffer if you face a job loss or unexpected expense. Review your budget and see where you can cut back on non-essential spending. In terms of your career, focus on making yourself invaluable at work. Continue to develop your skills and network within your industry. Being proactive can make you more resilient in a tougher job market. And for your investments, this might be a time to be more conservative and consult with a financial advisor to review your strategy. Knowledge is power, and understanding the economic landscape allows you to make smarter decisions to protect yourself and your family. To summarize, we're seeing a clear and concerning pattern: rising consumer defaults, significant corporate credit stress, and a looming crisis in commercial real estate. These are not isolated incidents. They are interconnected pieces of a puzzle that strongly suggests an economic contraction is on the horizon. The easy money era is over, and we are now navigating the consequences. The path forward will likely be bumpy, but by staying informed and taking prudent financial steps now, you can better position yourself to weather the potential storm. It's about being prepared, not scared. Thank you for joining me for this deep dive into the state of the economy. I know this can be heavy stuff, but it's incredibly important to understand. If you found this analysis helpful, please hit that like button and subscribe to the channel for more content like this. Let me know your thoughts in the comments below. Are you seeing these signs of stress in your own life or industry? Let's continue the conversation. Thanks for watching, and I'll see you in the next video. Have you seen the numbers lately? Credit spreads are exploding. We're talking 1,200 basis points in the US and a staggering 1,800 in London. If you think this is the peak, think again. History and the data tell us this is just the opening act of a much larger credit crisis. What we're seeing isn't just a minor market correction. It's the beginning of an accelerated deleveraging phase. Think of it like a snowball rolling downhill. As credit spreads widen, it puts immense pressure on borrowers. This reduces the amount of credit available and forces businesses and individuals to shed debt. This process feeds on itself. Forced asset sales drive down prices. Lower prices damage balance sheets. Damaged balance sheets make it harder to get loans, which in turn widens spreads even more. It is a vicious cycle that doesn't stop until all the excess leverage that fueled the boom is completely wiped out. Now, let's talk about the lenders. You might think they're in the driver's seat, but they're actually stuck. In a systemic crisis like this, traditional credit analysis goes out the window. It doesn't matter how good a borrower looks on paper. When the entire economic system is under stress, even high-quality borrowers can get into trouble. Their revenues shrink, and refinancing costs skyrocket, making previously manageable debt completely unsustainable. So what do lenders do when they can't reliably tell who will survive and who won't? They pull back. They stop lending across the board. This broad reduction in credit is like cutting off the oxygen supply to the economy. It forces even healthy borrowers into distress, which leads to more defaults, and that just reinforces the lender's decision to stay on the sidelines. We're getting dangerously close to a credit freeze, where it becomes nearly impossible to get a loan, no matter how good your credit or collateral is. When a credit system freezes, the only mathematical outcome is economic contraction. The economy has to shrink until it reaches a level that can be sustained without a functioning credit market. Or a government has to step in with extraordinary measures to thaw the system. But given the current political and economic climate, those extraordinary measures might not be enough, or they might not come at all. That leaves economic contraction as the most likely path forward. And the size of that contraction depends on how much our current economy relies on credit. Spoiler alert, it's a lot. Modern economies are built on credit for investment, consumption, and day-to-day business operations. Even a temporary credit freeze can have an economic impact that is far more severe and lasts much longer than the credit problem itself. The current spreads are a blaring siren, signaling that this isn't just temporary stress anymore. We're heading into a prolonged adjustment period that will have a significant economic impact. The adjustment has already begun. The spreads have blown out. The lenders are stuck. What happens next is the big question. Can policymakers restore the credit system before the economic contraction gets too severe? The evidence suggests their options are limited, and a major economic adjustment looks inevitable. This isn't a forecast or a prediction of a future event. The credit crisis has started. The numbers don't lie. 1,200 basis points in the US, 1,800 in London. These are just the initial tremors. The system that supported credit creation for the last decade is broken, and broken systems don't fix themselves overnight. They break down further until the root imbalances are resolved. The breakdown has begun. The resolution will take time. And in credit markets, time is measured in pain. The pain has begun. Thanks for watching. Be sure to subscribe for more deep dives into the markets.